I was reading your October fact sheet, and you started with that famous quote of Warren Buffett. It says, "Time is the friend of the wonderful enemy, and a friend of the wonderful business and enemy of the mediocre." Right? And you also kind of go on to say that you firmly believe the economy is absolutely at the bottom. I mean, this is the pits. It can only get better from here. The only difference is, and they, I mean, well acknowledged that you should buy stocks when things are looking very, very bad, and they are looking bad. But the fundamental difference about this situation as compared to previous episodes is that when things were very bad, stock prices also used to be pretty poor. They used to reflect some of that. But we don't have any of that. I mean, if you want to buy good businesses, you're basically paying top dollar and more. So how much of that argument that, well, you should buy when the economy is down in the dumps really holds at this point in time?
So, what we think is that, we are coming out of a big lull period in the earnings season. For corporate profitability GDP, if you look at it, it's a multi-year low, it's a 15-year low. It is comparable to 2003 levels. It is now 2.8%. Earlier it was 5.5% in 2008 Jan. And 2003 it was around the same level of 2.7%. So we are clearly multi-year low in terms of corporate profitability GDP. And that is something which I've learned over a period of time, that that can actually be a mean reverting metric. If you look at the earnings of various companies, all the corporate banks, 7 years they have been writing off the loans, bad loans, and provisioning is going on.
Is that on the corporate profitability as a percentage, the GDP keeps coming down, it will mean revert automatically.
Yeah, so it happens. If you look at 100-year data of US also,
right.
When they were actually an emerging market and when they were changing to a developed market, the situation was more or less the same. And if you had seen that multi-year bottom of corporate profitability GDP, if you had bet on it, you would have made handsome money over a period of time. In 2003 also, when we started off the capex cycle and the huge growth rates in GDP, and the environment was very conducive globally also, it was very apparent that a lot of strategy reports which came in was saying that it's a death knell of India. And after that we saw a big boom in the markets. Now, the question to ask is that, is it the time to bet when the GDP is low, or when the GDP is actually galloped much higher, or credit growth low, you have to bet on equities, or when the credit growth is at 23% like 2007 kind of situation. IIP growth is negative, is it the time to bet on equities, or when the IIP growth is at 18.5% like 2007 kind of situation? My belief is that, this is the time to look at these companies and stocks which have not done well probably in the last 3 to 4 years or 5 years. Maybe the cyclical bottom has come and we have to bet on those set of companies. Maybe a lot of high-flying companies which has done very well in the last 3-4 years, probably you have to take a back seat in those set of companies. For
I'm just one point. You identify some themes as well: market share gainers, unorganized to organized, underpenetrated sectors and beneficiaries of Indian demography, exporters, anti-pollution, right? These are themes. I mean, within the themes you identify sectors: private corporate banks, private insurers, real estate, FMCG, retail, consumer durables, except IT and pharma. Maybe pharma actually more than...
actually overweight on pharma.
Correct. I mean, the rest of the sectors, they're all pretty much trading at, historically high valuations.
Not really. If you see, what is the biggest theme you have to play in the next 10 years, in my view? Because, near term, always it's very uncertain. But if you look at whatever actions government has taken in the last 3-4 years, first it came with a demonetization, a lot of digitization, a lot of money shifting to digital media, it has happened. And secondly, the GST, then RERA, IBC, even the tax cuts. If you look at it, the entire thread is clearly suggesting that unorganized to organized shift is apparent, and the biggest unorganized to organized shift is happening in real estate. If you see, all the mid-sized builders are almost, has come off quite a bit, and the large builders will become larger. So we are very positive on real estate as a theme to play, or the sector to play in the next many years. Which are the companies, which are the sectors which are facing the biggest cash crunch in the current situation? One is auto sector, second is real estate, and third is NBFC. So you have to bet on the survivors who have the best distribution reach, best brand visibility. I think a lot of companies you can pick and choose in that regard, from the auto sector, and lot of noise around auto sector also going around.
How are you placed on telecom?
We are overweight on telecom, and there are multiple ways to buy telecom, right? You know, either you buy the direct beneficiaries or the holding companies which are having the exposure to telecom. So we are actually overweight. 10 years back, you know, the discussion we used to have while I was in my previous organization used to be that, you know, 2G is there, 3G is going to come. This is, I'm talking about 2008. And, you know, 4G has already got launched by many companies globally. Is it the best time to bet on telecom? So my view was that the companies have to consolidate, the sector has to consolidate, and there are so many opportunities which will come up once the consolidation is over. Now we are in the consolidation stage. Price hike is visible, and, you know, prior to that itself, it was clear that most of the companies are making losses.
Sure.
Right.
That's on telecom, but just lastly, what kind of choices are you making within private corporate banks? Because it's difficult. We've seen quite a few negative surprises which have come through in terms of stocks. So how are you making the distinction?
Yeah, so in a leverage sector like financials, you know, you have to bet on good quality companies who have large balance sheets and who has significant presence in the in the marketplace, and who has taken mind share of the customers. So when you look at from that perspective, the large corporate banks are the ones which we like the most, and not the ones which are starving for capital. So the ones who are having good tier 1 capital ratios and are present pan-India and large ones and large balance sheets, they will be the biggest beneficiaries.